Hello, everyone. I'm Matt Clark, research analyst of the Money and Markets, and joining me as he does each and every week is Green Zone Fortunes co-editor Charles Sizemore. It's time for another edition of Investing with Charles, and this time we're going to bring about some holiday cheer for you. And I mean that. I don't really mean that in terms of holiday cheer, because this is a time of season that produces the most stress for not only individuals who are shopping, but those especially working in the retail industry. And that kind of leads right into what we're going to talk about today, as we are right in the midst of the holiday shopping season. It is Thanksgiving. It is Black Friday. It is just what used to be, however, just a massive run of lines and crazy people and insane deal shopping has really kind of drifted away from that. As stores have decided, well, we're going to be proactive and release our Black Friday deals on November 1st rather than on the day after Thanksgiving, 20 some days later. And this has been the experience this year. It was a little bit last year during the coronavirus pandemic, but now stores are starting to decide that, you know what, we're not going to make Black Friday such a huge deal. We're just going to spread things out and give people longer to take advantage of special deals and things like that. But regardless, this next month, from around Thanksgiving to Christmas, is where a lot of retailers, that's where they earn their money. That's where they make the big bucks. That's where their profits are really shown, because this is the time of year where Americans spend billions of dollars on shopping. And it's forecasted. I think I did a story for Money and Markets a week or so ago talking about retail, and this is expected to be a record-breaking holiday shopping season here in the U.S., approaching, I think, somewhere in the neighborhood of $800 billion in shopping, which is a massive jump, especially coming out of the coronavirus pandemic. So today, I want to talk about two retail stocks that are very well known and that have the potential, and they both have done very well in previous holiday shopping seasons, and are probably going to do just as well, if not even better, this time around. I'm going to bring in Charles to talk about that. And the two stocks I want to hit on today are Walmart, trades on the New York Stock Exchange under the ticker WMT, and Amazon.com Incorporated, which trades on the NASDAQ under AMZN. So first off, Charles, I think you are out of country here. So I don't know what Black Friday is going to be like in Peru as compared to what it's going to be here in South Florida.
Well, they already have the Christmas trees up here, but one nice aspect of being out of the United States this time of year is that I have no pressure to go participate in the Black Friday madness. You will not find me in the parking lot of the mall at 3 o'clock in the morning, fighting and throwing punches to get my spot in line, because Christmas spirit and all. Let's do that. But anyway, that's the beauty of not being stateside this time of year. There's absolutely no possibility I could ever get drawn into that.
I just remember the insanity of, even as when I was a journalist covering Black Friday events in no matter what market size, whether it's a large city or a small town, Black Friday, I worked in a county that had a population of about 30,000 people, and they had basically their big store was a Walmart. And on Black Friday, even Thanksgiving night, the night before, the lines at the Walmart were massive. And it's even more so as you move into larger cities where you have Best Buy and you have Home Depot and you have Target and you have all those other stores. The lines are just huge. Now, that's really not the case. It's no longer an issue. It's no longer, I got to wait. I have to sleep off my turkey from Thanksgiving, my tryptophan coma, in order to get up at 2 o'clock in the morning to rush out to the mall and stand in line.
I would like to think we've evolved as a species to where we just no longer do the Black Friday thing, but that's not true. Black Friday it starts a month earlier now. It's
exactly. Exactly. Like November 1st, everyone, stores are throwing out their deals. But
it is an interesting point, though. Like, the reason we had Black Friday before was there was this feeling, I don't want to say of exclusivity, because there's nothing exclusive about making a line with 1,000 other people in front of Walmart, but this urgency, this sense of urgency that this is the day, you need to be here right now because this is when it's happening. It's an event. And when you start Black Friday a month early, that sort of dissipates. You don't have that sense of urgency to get out. So I don't know. I guess the marketing wizards here have figured this out. They know how to squeeze, every last penny out, because I think of that 800 billion getting spent, in the Christmas shopping season, only 700 billion of that is going to be on my credit card. So apparently this stuff really does work, but it is interesting. I would have always thought that keeping it kind of in this fixed part on the calendar is actually better because it creates that sense of urgency. Spreading it out just sort of dissipates it, but
it loses its luster. It loses its luster, but I still think there's going to be some lines, but it's not going to be nearly the craziness that you and I experienced, even a decade ago, or when we were kids, or things like that, where you're waking up at 2 a.m. to go stand in line, and it's craziness, and you're mapping out.
I've never done that. I have done some things I regret in life, but waking up at 2 a.m. to go wait in line for Black Friday is not anything I've ever done.
I only did it by force, not because I wanted to. So now to zero in here, first off, I want to talk about these two stocks specifically, because I did a lot of research on these stocks and did some comparisons and things like that. So first we'll look at Walmart. Walmart's 12-month performance so far is not what you would expect. Right now, if you look at Walmart stock over the last 12 months, the stock performance is actually down about 4.2%. It's trading about 2% below its 50-day simple moving average. And if you compare that to the general merchandise retail industry, that industry average is up 16%. So you've got about a 20% difference between how Walmart stock has performed compared to its peers. And it's 20% that's not in Walmart's favor. Is that shocking?
No, it's actually not shocking at all. Think about last year. Last year, half of retail America was closed for large stretches, or had reduced hours, or even if it wasn't officially closed, people weren't really going, right? Whereas Walmart sold basic necessities. So Walmart, 2020 was a fantastic year for Walmart. They made hay while the sun was shining there. Now, what happened? I mean, the stock got ahead of itself. A lot of those, it did so well last year that it was sort of due for a cooling off this year. I would say this year's stock performance is not indicative of, failing business performance on the part of Walmart. Walmart's doing what they do. It's one of the best retailers in the history of retail. Arguably, until Amazon came along, Walmart was the undisputed king of retail. They just manage their business phenomenally well. So this is not a question of Walmart not getting it together. It's more just a question of, 2020 was so good that they had nowhere to go but down after that.
And if we take a look at its green zone rating, and I'm pulling it up right now just so I have reference to it. Right now, Walmart rates a 55, which is very neutral. Its size obviously pulls it down because it has a massive market cap of almost $400 billion. It does rate in the green in both value and quality, as well as volatility, which means its stock has not really moved downward in any significance. It has moved down. Obviously, we've seen that, but it's been more of a flat movement over the last 12 months, indicated by the fact that it's only down about 4%, which for Walmart stock price of around $140 to $143 a share is not that significant of a move. So
with the volatility rating of 85, this is not a stock that's going to make you sick to your stomach. You're not going to have, you're not going to be nervous and chain smoking watching this stock move. It's a low volatility stock. One thing I would point out, we'll come back to this when we discuss Amazon, but the value rating of 61, that's not dirt cheap by stretch. But if you kind of dig into those numbers, Walmart trades for less than 1x sales. So it trades at a retail valuation. It's not, its valuation here is what I would consider fair for a large retailer.
Now, the other thing that I did here is I looked at Walmart and I compared it against the S&P BMI Retailing Index, which is a broader index used of S&P 500, S&P companies, and it kind of shows its price movement. It's basically just a sector index, if you will. And interestingly enough, you pull this up, looking at it just year to date, from January of 2021 to today, the BMI Retailing Index is up almost 26%. Walmart down 1.2% in terms of comparison to that value. So again, I think this is where we see Walmart had a phenomenal 2020. And so now it's kind of,
and its peers did not. Remember, a lot of these retailers really struggled last year. And so some of that outperformance is those competitors catching up.
Right. And so now we're seeing Walmart kind of come back down to reality a little bit, whereas its peers are now experiencing that growth, that price movement that Walmart saw last year. So it's kind of a tale of two different types of performance here. Walmart is paring itself back from a massive 2020. Its peers are moving themselves up after what was probably a lackluster 2020. So it's kind of, when you compare the two, it's not necessarily fair to say that Walmart is in the dumps or poor to look at or anything like that. It's just that Walmart is back down to reality. And now you see that other retailers are moving themselves in that upward direction that Walmart had last year. Now, shifting directions, let's look at Amazon. We pull up Amazon stock chart right now. Again, general merchandising is up about 16%. Amazon, on the other hand, is actually beating its peers. It's up 18, almost 19% over the last 12 months, and is trading massively high. It's trading double its 50-day simple moving average, which is actually pretty impressive. We can't use that really strong 2020 to explain away a bump up for Amazon. So why is Amazon up here after they had what was actually a pretty decent 2020 as well?
Well, so I've always said Walmart, if there was any company in the world that could, in theory, compete with Amazon, it would be Walmart. But Amazon's still the king here. Amazon is taking over the world. This is a foregone conclusion. This is happening. Like, the tanks are just rolling over. I mean, this is happening. Like, you can like it, you can not like it. It doesn't really matter. Amazon's taking over the world, right? And so you see that in the stock price. And it's also important to remember, Amazon is not just retail. Retail is what we experience because the boxes show up at our doorstep. But Amazon is also the leader in cloud. Like, they are at this point, by pretty wide margin, the leader in cloud computing. Microsoft's in the game, Google's in the game, IBM's in the game. These other players are in the game, but Amazon is really leading the charge there. It's also becoming a logistics company, much more, I guess. Well, Walmart is a logistics company as well, but Amazon is building out a global fleet here. So it is a different kind of company. It's more than retail, and that shows up in its valuation. Well, I said that Walmart has a price to sales ratio of less than 1. Amazon's price to sales ratio is over 4, which puts it in valuation territory similar to a tech stock, similar to Microsoft or Google. So that's kind of the difference here. Amazon is not simply a retailer; it's a retailer and a tech stock.
It is much more broad, and it is leaning very heavily on its AWS platform, its Amazon Web Services platform, to generate a ton of sales. It really bolstered the stock during 2020 as work from home and companies realized that we need to have access to data and information that's broader than just being in-house. So a lot of companies were turning to AWS to either jump into or expand those web services, and Amazon received a big boom from that.
But that trend was already in place long before COVID, by the way. That was an unstoppable force even before COVID. And then COVID just came and just dumped a huge tank of gasoline on the fire. It took a trend that was already just blowing it out and just sent it on an even higher trajectory there. So I mean, it was very impressive how that played out.
We'll look at the green zone ratings here, and I'm looking at them right over here. Right now, Amazon actually rates lower than Walmart. Walmart is a 55, Amazon is a 43, both still in neutral territory. Obviously, Amazon gets just dinged on size. Of course, you're almost at $2 trillion in a market cap. That's, without question. If you remember the stock chart, you saw that its stock price was kind of all over the place. So its momentum ranks very low. Interestingly enough, Amazon ranks in the green in quality and growth, so two fundamental factors, and it also ranks in the green in volatility, despite the fact that we've seen some bump ups and downs in terms of its stock price. But you also have to bear in mind, Amazon is priced at around $3,600 per share. So its movements, while seem vast, are a little different just based on the price of its stock.
Well, there's another point to make there. Generally speaking, the bigger a company is, the lower its volatility is. That's just as a virtue of size, you tend to get less volatility. And this is a massive, massive company, to be sure. It is also interesting. Yeah, I mentioned the valuation difference between Amazon and Walmart. This Amazon really gets zinged badly on value. It rates at 12. I mean, it really loses its shirt there. But the good thing is, if it loses its shirt, it can just one day deliver or same day deliver a new shirt using its own platform. But
exactly,
that was very poor joke.
Only if you're a Prime member.
Only if you're a Prime member. But yeah, so this is Amazon is by no stretch of the imagination a cheap stock. It is expensive, but you're buying the growth, you're buying the dominance, you're buying the world-beating market position here. It's very rare to find a company of this quality that actually trades cheaply. It happens, but it's rare. So the low score you see on value here really is to be expected.
And then again, to kind of compare apples to apples here, you take Amazon against the BMI retailing index. Obviously, the retailing index up almost 26% of year to date. Amazon up 12.8% year to date. So whereas we saw Walmart, which was actually down about 2% year to date, and Amazon is up almost 13%. So you have that, and then if you take all three and kind of put them together in one chart and you spread that out, I did that on a year comparison rather than a year to date, and you see that Walmart is down about 4%. You've got Amazon, which is up almost 19%. And the BMI retailing index is up almost 33%. So here again, we see, if you're looking at the retailing index, as we've talked about, a lot of the retailers that were peers to these companies saw very, very poor 2020s because of lockdowns, closings, things like that. Walmart was an essential business, stayed open. It has essential supplies, and it really made its bones that way. And then Amazon was able to kind of obviously capitalize on the online buying trend, but also really leaned into its AWS platform and its logistical underpinnings there, and they have continued to move upward and are still showing a very positive trend. So if we look at Amazon, Walmart, compare that to the retailing index, you look at its green zone factors, you look at everything and compare it all together, you have a very compelling picture here in terms of a potential buy here. Now, you mentioned, its multiples, and obviously value is one thing. I want to specifically kind of segment into price to earnings. This is probably the most popular price to multiple that retail investors look at in terms of determining a valuation of a company. And if we pull up from 2018 to 2021, obviously Amazon started at a trading multiple, a price to earnings ratio of close to 200. It was massive. And since then, we've seen a decline. Walmart, on the other hand, has been relatively flat and has started to tick upwards as its stock price has gone down. And right now, as of today, you've got a P/E ratio for Walmart of about 52, and you have a price to earnings ratio for Amazon of about 64. And we see that gap has narrowed significantly, meaning that what this indicates to me is, at least based on this multiple, is that these companies are getting much closer in terms of their valuation for their stock price.
On the forward PE, Walmart is a bit cheaper, but you're right though. Walmart is not. It used to be that Amazon was just ridiculously expensive relative to everything. And that's not necessarily the case today. It's an expensive stock for sure, but we're in an expensive market. So Amazon is an expensive stock in an overall expensive market, but the degree of its potential overvaluation here relative to its peers is not as big as it was before. Not at all.
So if you look at these two stocks, and as we celebrate Thanksgiving and what is left of Black Friday, if you had, gun to your head, had to pick one of these two stocks to invest and put in your portfolio, which one are you going to go with and why?
I like them both. I think both would be great, just kind of buy and hold forever holdings. It's something you could drop in a drawer and forget about for 20 years. That said, if I'm only picking one, it's Amazon. As I said before, this is the company that's taking over the world. why would you not want to be a part of that? Why would you not want a piece of that action? Even if their retail business sort of flattens out, and there's no indication it is, by the way, but let's just say it does, you still have the cloud business. You even have their kind of secondary and tertiary businesses like their video streaming. Amazon's everywhere. Everything they do, they go in big, they go hard, and they win. So I don't see a reason not to own the stock.
And I agree. I think there's just too much here. Amazon is way too diverse. You've got the tech, you've got the video games with, I believe it's Twitch, I think is what I could be wrong there, but with their video game streaming, things like that, they're getting into, autonomous driving, autonomous vehicles. Of course, that's very self-serving because they're hoping that they can get self-driving delivery vehicles. Then you have drones, you have, all these types of things that they're testing and getting into different markets with. You're right. When they go in big, and they have the clout and the finances to knock out just about every competitor in the market, or just
the audacity and just the audacity to do it. They have the audacity to dream big and follow through, and you got to respect that.
Absolutely. And this is a company that it's big in the US. It's starting to make more of an international footprint. It's not Alibaba, which is huge in Southeast Asia and in China, is actually referred to as the Amazon of China. So it's not that Amazon is the Alibaba of the US. It's that Amazon is the staple. It is the benchmark. It is, when it comes to retail and online retail specifically, it is the standard. And I agree. I like Walmart. I think it's a great stock. It's one of those where I think you can buy it, you can hold it, and you're going to see nice returns over the course of 5 years, 10 years, 20 years, whatever. It's going to be a stock that's not going to go away. But I think if you're looking for diversity, if you're looking for, a stock that is probably going to grow faster, and just because of its
looking for a stock to pass on to your grandkids someday, it's Amazon. Yeah.
It's Amazon. Without question, it's Amazon. I mean, I like the fact that it's in different sectors. I like the fact that it's not just resting its laurels on retail. Its cloud platform is solid. It's not going to go anywhere. It's very inexpensive in terms of its price compared to, an IBM or Oracle or anything like that. So I think you've got a lot of positives working in favor for Amazon. And, yes, in terms of its stock price, it is pricey. It is a pricey stock. But if you have the money to invest in that kind of a stock, then you probably aren't too worried about a $3,500 price tag on a stock. If you have the money to buy that kind of have that kind of buying power, then the price isn't going to be that big of a deal for you.
Fair enough.
This is just my thought. And there are other retail stocks out there. You and I were talking off air a little bit about Home Depot, which is trades on the stock exchange or HD. You got Target, trades on the New York Stock Exchange or TGT.
Both of which rate well, by the way, on our Green Zone rating system.
They do. They actually rate better than either Amazon or Walmart. But again, you just do your due diligence and pick on all four of these stocks are going to be ones that are not going to go away anytime soon. They're all going to be they're all going to show solid momentum. They're all going to show upward trajectory. They all are in consumer cyclicals, and they also dabble in consumer discretionary. So you've got a nice mix of potentials in terms of sectors to invest in. So, Charles, any other parting shots as we close out the holiday and then get geared up for what should be a rousing Christmas season?
We are entering that seasonal time of the year when the market does tend to do really well. So, don't go mortgage your house to go dump money into the market or anything crazy like that. But I would say, you look at the market right now, it's been kind of wobbly for the last few months. It can be a little bit nerve-wracking, but I would say for now, stay long and strong. I think this is a good time to be invested until the market tells us otherwise. I'm staying invested.
And we did show you some examples of our Green Zone rating system. Do check that out on moneymarkets.com. You can just go to moneymarkets.com very simply. Up on the top right side, you'll see a bar. You can type in any stock, any ticker, and you can pull out its ranking that we have and see how it ranks in different factors, things like that. It's a great tool to get started if you're looking to maybe compare some stocks, see what may be good based on whatever your portfolio calls for. Also, don't forget to check out Charles Sizemore, Adam O'Dell, and myself with our Green Zone Fortunes investing service. We'll try to show you some, get you a link to click to where you can see more information about that. And don't forget, if you do have a question about a particular stock or a sector or anything that may be moving the market, you have a question for myself, for Adam O'Dell, for Charles, just email us and ask. That email address is feedback@moneyandmarkets.com. We'll flash that down below, or you can comment down below here on YouTube. We'd love to do that as well. And with that, that's really all I have, Charles. We really appreciate the time taking a look at two big, giant stocks. I think we provide a lot of good insight for people to really think about on Black Friday as Black Friday comes to an end, and we have a long holiday weekend, then get geared up for Christmas and New Year's. So we'll have much more coming up next week. So make sure you stay tuned on YouTube for that. So for Charles Sizemore, Green Zone Fortunes co-editor, I am Money Markets Research Analyst Matt Clark, wishing everyone safe trading.